Hey, quick history lesson. It was 1949 when China initiated its one-child policy. Yet it's here now in 2024 that the real problems are coming home to roost. In China's low birth rates, its dire economy, and its declining stock market. We'll dive into that right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
There's been a tremendous amount of media coverage regarding China as of late. And when I say as of late, I'm not talking about just the last few days. I'm talking about months, if not the last few years. Obviously, China can be a trade partner or a trade adversary. China is a political force. A communist entity, which kind of flies against some of the freedoms that we hold so dear. They have a unique perspective in terms of what they've done to control population over the years, and that's coming back to bite them right now. And from an economic standpoint, they have been in a bit of a tailspin, and it's something that I think a lot of people don't truly understand. We're going to dive into what some of this looks like and how it kind of relates over to the United States as well as the rest of the economic world. And as always, we're plowing into lots of different data here on the Trend Report. Our data is ending as of last Friday, which is February 9th of 2024. So let's jump right in. Now, right out of the gate, you can pull headlines. These are just some random headlines that I pulled across the top of this screen just to kind of illustrate, if you haven't been paying attention, some of the attention that China is in fact getting. Wall Street Journal, this is as of the middle of January. China's growth rate slows to a 3-decade low, excluding the pandemic, meaning that they're kind of giving them a free pass on the pandemic. And nonetheless, even with that out of the way, they're at this 3-decade low. CNN reporting that China's economy had a miserable year and 2024 could be even worse. And then the AP is saying that China's economy is forecasted to slow sharply in 2024, according to the World Bank, and that their recovery is fragile. Now, many of you will recall the famous concept of China dampening their population and putting requirements on women, families, and couples in terms of how many children they can have. And there's all kinds of information you can pull out on that. But basically, this kind of cuts to the chase of a lot of what's going on, because this all trickles down into the economy. So just last week, February 12th, the Wall Street Journal wrote this article, How China Miscalculated Its Way to a Baby Bust. And I had not known this before, but it turns out a missile scientist was the mathematical magician behind all of this, pushing models on the nation's one-child policy. And now that's just kind of ingrained in society. And so there's two charts here that really kind of say it all. The Chinese population, and here's 1950 going up into the early 2000s, just rising constantly. But now the projections based on birth rates are showing that the population is going to be turning in the other direction, and in a great way. So it's just barely now starting to turn, but they are predicting that it is going to drop dramatically on a rolling forward basis. And the main reason for that is the average number of lifetime births among women in China is running currently at about 1. Now, the replacement rate, if you will, from an economic standpoint and just the actuarial tables that exist based upon life expectancies and death rates and so on and so forth, is you need to be repopulating. And this is not a China thing. This is a world global thing. You need to, generally speaking, be repopulating at 2.1 children per woman in order to have a flat line population. So in other words, it takes a couple to make a child, and therefore that couple, being represented by the woman who gives birth, needs to replace themselves. And in order to do so, they need to have two children plus zero point 0.1, a little more than two children, if you will, to offset medical issues and death rates and so on and so forth. So 2.1 is kind of the number, and they are running at 1.0 roughly right now. So that's a big reason why we're starting to see this just kind of this massive ship trying to turn, or not trying, but turning in the harbor to head back the other direction in terms of China's population, and then how that trickles down into their productivity or lack thereof as they're losing more and more workers, what that means then to the economy, and ultimately what that means to their stock markets. So with that being said, let's jump into some examples. Now, normally, and I will still show you the normal data that we give you each time here on the trend report, but take note that this is showing a 3-year trend. Normally, I show you a 1-year trend as our normal data that we're showing, but I want to show you a comparison between the S&P 500, essentially representative of the United States, and then the total international. So the S&P 500 up here, and then we're going to take a look at the total international stock market. So that's all the rest of the entities not or economies not counting the U.S. And then we're going to take a look at the China fund. And by the way, you'll notice that the China index fund is at the bottom. So when we're ranking everything by our trends, which is the trend is down here. Generally speaking, green means it's tilting bullish. Red means it's tilting bearish. When we look at that, and here we are looking at the S&P 500 here over the last 3 years. If we start here and we go up to here, over the last 3 years, there's been about a 27% increase in the S&P 500 over the last 3 years, literally ending last week. And as you can see, we had some nice growth rate here with a bullish trend, another bullish trend. All of these green dots are the swings. So we've got these nice swings up that were taking place through here. And again, the end result is we have a 27% growth rate. So now let's jump down and look at the total international. I'm going to switch pages. So here we are looking at the total international. Now, if we do the exact same thing, we start here and we run down to the current status on the total international ETF. We're coming in at minus 11%. So we were plus 27 on the S&P 500. We're minus 11 on overall total international. But now look at where China is. Again, China's the only one showing red on our trend number, meaning it's a negative number. If we jump to China next, which is right here, and we start here, and we come down to current times, we're looking at a 61% drop in the China index fund, which is essentially representative of the Chinese stock market. So there is a dramatic difference. I'll compare the S&P 500 and China side by side. So there is a dramatic difference between a positive 27%, a negative 61%. So almost a 90% swing from positive to negative in the difference between the S&P 500 and its performance over the last 3 years versus the China index fund and its performance over the last 3 years. And by the way, I should also note that this blue line right here, this is the 200-day moving average. So as you can see, it is consistently, stumbling over my words there, it is consistently running below its 200-day moving average for the most part during that time, that 3-year time frame. And again, the opposite is true on the S&P 500. Now, we did see some dipping below the 200-day average here, but we were above it back here and above it again back in this area. So a pretty significant difference. So this is why you're getting so much of these headlines on the top of this page talking about China. And I've actually heard certain economists talking about the ultimate failing of the Chinese economy and the Chinese state, if you will. I believe that to be a pretty dramatic statement. I highly doubt that that is the path that we are truly on in terms of like them failing in the next year or two and not existing anymore, at least not existing the way we know it. But I do believe that they need to fix some things. They've got some very broken mechanics inside of their economy, inside of their culture, inside of their productivity. And as I stated, much of that relates back to just core philosophies such as childbirth. But obviously, their core philosophies differ from ours dramatically when you compare what it means to be a communist versus what it means to be a capitalist, what it means to live in a free environment versus a communist environment, and so on and so forth. So hopefully the world itself and our children will get better educated on this and understand what's truly going on if you dig deeper into the comparisons and specifically from a stock market standpoint, what's really going on here in China. So I hope that gives you a bit of an example or a bit of a rundown so that you can start to understand why you're seeing these things going on in China. So some people will be like, well, the goods moving back and forth, and if we're trying to put tariffs on China and so on and so forth, how does that really affect us, and or how does that really affect China? Well, it's been affecting China dramatically. China is having some issues, and you're starting to see that a lot of things are shifting to other countries in terms of where we're getting some of our goods and services these days. Now, we're going to jump into our normal conversations on our one-year rolling charts and trends that we always provide you here. So if we're looking at a one-year capitalization grouping, capitalization meaning we're going from large caps all the way down to small caps, and then we're identifying the overall stock market, and then using the trending system to determine what's lifting up the market, what's propelling the market versus what's dragging it down. So the overall stock market, represented by the Vanguard Total Stock Market, is in a bullish trend right here, all this green, and it is also in a bullish swing right here in these green dots coming up. So it is ranking quite nicely. And again, this is the trend down here, and these are the swings, these dots and such that we see in here. And you'll notice that all of the U.S. capitalization subsets are coming in positive on a bullish trend calculation. But what's really lifting things up tends to be the large caps or the mega caps right now. We've got the S&P 500 leading the charge, the QQQ, better known as the NASDAQ 100, the Dow Jones Industrial, and the S&P 100, which is the 100 largest stocks within the S&P 500. So obviously it is the very large stocks that are winning in the trend. Down at the bottom is our small caps and our mid caps. We've got the Russell 2000 small caps, we've got the S&P 400 mid cap, and then we've got the 600 index and the 600 value, and actually right here is the 600 growth. So if we break things down by the index itself and then value and growth, you're really finding them all lumped together here in the small cap arena down at the bottom of the trend. But again, keep in mind, it is still green. It is still positive. We are getting some bearish swing here at the very bottom, but for the most part, we're seeing green, which is bullish. When we go to sectors, now there are 11 different sectors that make up our stock market. So if we equal weight all those sectors, again, we bring it over here. We're seeing bullish trend down here on the bottom. We're seeing bullish swing right up here with the green dots. We are nicely above our 200-day moving average here that we talked about earlier. So the real question becomes, well, which sectors are lifting or buoying up the market versus dragging the market down? Information tech, health, and industrials are right up here at the top, really helping to lift things. And then you'll notice the bottom three are actually showing bearish across the board. They're showing bearish on trend and bearish on swing, and they're coming in negative numerically for the trend, obviously, as well. And that would be energy, utilities, and we do have silver and gold and REITs in here for you as well. So we've got silver down here at the very bottom, but energy and utilities most specifically, with real estate being not too far behind on the lower end as well. If we look internationally, which we sort of did a moment ago because we compared the S&P 500 to the Vanguard Total International Stock ETF, which we're looking at here again, versus if you recall a moment ago, we went into China down here. So here's the S&P, here's Total Vanguard, and here is China again. So the overall international is still showing bullish as well on its trend. It is getting a bullish swing up right now as well. What's really lifting it is the European growth, some international dividend, and so on up here at the top. What's dragging it down continues to be China, the one with the negative number, but we're also seeing Latin America and some emerging markets and such down here as well. And then finally, in the bond arena, bonds are showing to be a little more fragile right now. The overall bond market is still showing a bullish trend, but it has turned to a bearish swing as of late. And you'll notice that we've got red down all this column of the swing numbers. So we are seeing a shorter term swing towards the bear, but for the most part, the trend is holding on the bull. Up here at the top, you're getting your municipalities, your high yield corporate bonds, your short-term corporate bonds, and your intermediate corporate bonds. So some of the smaller stuff is actually winning the day in the bond arena, and then some of the bigger stuff is down here at the bottom. The total international bond market is way at the bottom, and then we've got the U.S. Treasuries kind of rounding out the bottom down here as well. So some of the big stuff, so to speak, is performing a little less and bringing the overall bond market down a bit. So lots going on here, but I think you will find that the U.S. equities markets are continuing to hold pretty strong right now. China and some of the international players are in a weaker spot than we are, but we will continue to see what goes on with this bond market and interest rates as the Feds determine if they're going to, in fact, actually start lowering interest rates again. Thanks, everyone. I hope this is helpful for you.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.